regardless of your health. You could be on your deathbed. We guarantee that we'll renew it at that price. Derek here, back with another very fundamental financial Fundie. This week I want to talk about the difference between term insurance and permanent insurance. Now I've been told, I got a chart here, I've been told that my sketches are ridiculously illegible, so I've printed some stuff off this time. So term insurance, obviously it is insurance that you own for a specified period. The most common, it would be a 20-year term, 10-year term, and after that period, of course, the price increases. Now, permanent insurance is permanent. You have it for life. The difference, of course, is in the cost. So have a look at this real quick, Noel. You got this on here?
Oh, 100%, man.
Okay, so this side is cost. This axis is time. So ignore this curved one. That one's yearly insurance. So now term costs you is quite affordable early, but when it renews, let's call this every 10 years, 10, 20, 30, the price jumps. What's more realistic with term insurance, and I'll show you on a policy quickly, is actually that first jump's big, that second jump is gigantic. It's more like this, that third jump through the roof, and I'll show you that in an example here in a second. Permanent insurance starts out higher. The cost is higher earlier, but the cost stays the same all the way to 100. So while it may seem expensive now, once this term insurance jumps, it's going to feel much more affordable later. Like I said before, this permanent insurance is really the sort of thing that you want for estate taxes. This term insurance is for things like mortgage and caring for your dependents. Now, we have two other examples up here. One is called a 10 pay, one's a 20 pay. It's just permanent insurance, and instead of paying for it forever, you only pay for it for 20 years, or you only pay for it for 10 years. So obviously the cost is, again, much higher than term, but after you've paid for it for 10 years, it's paid up for life. Okay, I put in a 35-year-old who has a term 20. This is a male, 35-year-old non-smoker. They're paying $35 for $500,000 in insurance right now. Maybe this is similar to the policy that you have right now. Now watch what happens here. $35 seems very affordable to cover $500,000 worth of risk, but look at what happens at renewal. At renewal, this price now goes to $556 a month. So here is my recommendation to you. If you have a term 20 policy and you're somewhere in, frankly, if you're somewhere even in you're at 10 to 15 to 18 years, you're probably still healthy. Renew your policy. That 556 is just a number that the insurance company says, regardless of your health, you could be on your deathbed, we guarantee that we'll renew it at that price. Now watch this. Another 20 years, this is the jump I'm talking about, another 20 years. Now 40 years from when you bought this policy. Can we see that, Nolan, what that price is there? I don't know if you can zoom in on that. No? Okay. So that number is $3,235 is what you're paying. Now, that's per month for that life insurance. So let me just give you a bit of advice. If you have a term policy, go see your advisor and say, hey, I'm healthy, I'm young, I'm well. Can I renew my insurance? Maybe you even say, I actually want to buy some permanent insurance to lock it in for life. So that is term insurance versus permanent insurance, and that for this week is your financial Fundie.